People often ask us how you predict the property market. What are the tools we have to try and understand when a market's about to boom and when it's about to finish its boom? Some of the key things to really understand is how the market behaves. If you look at the Sydney property market over the last 50 odd years, you can start to see that it largely has a 7-year boom followed by a 7-year plateau. Sometimes it's shorter, sometimes it's longer. That cycle is mostly driven by human behaviour, but also the fundamentals that drive it. Of course, supply, demand, population growth, employment growth, and infrastructure projects. But one of the things that precedes a property boom, a capital growth boom, is usually a rental boom. So that's one of the key things we look for. Has rent been increasing in the area? We use all these tools and we've been using them for about 17 plus years. So much so that in 2009 we published our forecast for the Sydney market and the start of the boom, illustrated by the arrow. So we got the start of the boom right and we also got the end of the boom right. It doesn't mean we're really clever. We've got about 15 different research companies that we source research from, including Biz Shrapnel, Residex, Hotspotting, SQM Research. All the banks have economic departments that do various things better than others. So we use all those what we call primary research sources, and then we're what we call a tertiary research house. We analyse all that primary research and we use that to help us forecast the market. It's really important to get it right. The difference between buying property at the start of the boom and at the end of the boom can be the difference between getting 10% growth and 100% growth over the next 7 to 10 years. We published our forecast in Peninsula Living magazine in 2009. You can Google it, you can find it on the web. It's published. And we also published the end of the boom. We've been recommending clients sell property for the last 2 years in Sydney and then use that equity that they've made over the last 5 to 10 years to then invest in the next growth market. At the moment, Sydney's only forecast to grow about 5 to 20% over the next 8 years, whereas other markets are forecast to grow by 60 to 110%, while having substantially higher rental returns. The gross rental return in areas like Brisbane is about 4.5 to 5% per annum of the property value, but the net is about 1% less than that, so about 3.5 to 4. If you look at the gross rental return of Sydney, you're at about 2.5 to 3.5%, and if you take that 1% off in costs, we're only about 2.5% net rental return. So the rental return in places like Brisbane, the net rental return is almost double Sydney's. It's about 60 to 80% higher. And not only does that give you better cash flow and better borrowing capacity, but that's often the leading indicator to better capital growth. So that's one of the tools we used to predicting the Sydney boom in 2009, and when rental returns were reducing and affordability was reducing in 2018, we said that was pretty close to the top of the boom, and that's when we started to sell to buy into other markets.